All right, now let's get down to some fun. Let's start looking at the plans themselves. So we have, again, a simple three-step process: manage, borrow, and present. So I've got 5 sample plans in here, and if you want to stop the video, if you haven't already done this, you can go through and click on each plan and just click through manage, borrow, and present and get a feel for the information and the flow. What I'm going to do is take you through a first plan and how to create a new client plan from scratch. And we'll show you how fast and simple that is to do. So I'm going to click the Create New Client button. And when I do that, you'll notice the software is WYSIWYG. What you see is what you get. It's always changing as you select various options. There's new material down below because you've started a new plan. If I'd selected an existing plan here, let's just say, let's call this plan Video to Sample. And I'll hit the tab button there. And you'll notice that the software is going to go through and sync this up. And it's going to go through and update this for you. And I've seen a change because remember, this is always showing me my top 10 most recent plans. So now it's updating refinance, video to sample. Now, this is my plan description. So what kind of plan is this? And I can pick from the options. Is it a review with a client? Is it a refinance? Is it a purchase? Is it a second home purchase? Is it a rent versus purchase, an open house flyer? We're going to go through each of these different options here. So let's just say we'll skip the review because a review just basically gives a title of review. So maybe if you've got a client that you've worked with in the past, you don't want to feel like you're selling them and you don't want to show refinance and be assumptive. So this will allow that plan to say liability review instead of refinance. But I want to do a refinance for my first example. So I click the refinance button. And it says add details, and I can click the button and say, well, what details are you talking about? So the only choice here is what additional amount do you have available from savings or investments that you would consider applying towards this refinance. So this is just a memory jogger or a question here that you might want to ask that question to the client. This could be, do you have a certain amount that you're capped out at, you're willing to spend on closing costs, or do you have some money that you're thinking about putting into the home at the refinance to buy the loan down? This is just a number that I want to know they have available. And let's just say they say, well, $3,000 is the most we'd be willing to spend on a refinance if that makes sense. So I could put that number in here. I can also leave that blank. It's just here to help. Now, there's no LTV or front ratio yet because we haven't gotten to the loan information. There's a referral partner box here. Now, this is a box that if I want to, I can expand and I can choose a referral partner. Now, right now, I have no referral partners. So if you've got a first lead coming in, I might want to click Add and begin to add that referral partner. And I can say, is it a realtor, an advisor, a lender, or other? And I can put in their first name, last name, certifications, licensing number, phone, fax, mobile, email, company, street address, zip code, website, and I can upload their photo and their company logo and save that. So let me just do this here. I'll call this Sample Realtor. And I'll just click Save for now. So I don't have a lot of information in there, but you're going to notice now that I now have this person, and it's going to assign this lead and this referral to that person. And it's going to start to graphically track the business that I get from that referral partner. Now I can assign this lead to that partner and then shrink it up and take it out of the way. But that now helps me with tracking. And later on, if I want to transfer the plan back and forth to my referral partner, it knows that they're a partner in the system. So you'll notice when you first start playing with this, in the second video we do, I'm not going to narrate. I'm just going to go through and do a plan straight through. And you can see how quickly we can create this plan for a client or customer. Now here we have the client information. I have their name, and we'll call this Lesson 2 Client. And we have their income. We'll say it's $100,000. And their tax bracket, we'll say 30%. I see my helper box again here. So with that calculator, I can click on it. It's always going to help me out. So what's the tax bracket? This client has $100,000 a year, filing jointly. So they're going to be at 25% federal. So I can come on and put that up here so I don't forget. And on the state tax rates, I don't know what those are. I click the button. We're going to go ahead and open up a current table for you with the current state rates in it. So you can take a look at those, and you can come down to your state, North Carolina, where I am, and say, we're 6 to 7.75 in that range based on a low to high. So it'll give you a range. Most of the time you'll know what it is in your state, but if you've forgotten or you're in another state, this will give you a range. So in our state, it's typically going to be the high, 7.75. So what that does is it tells me I'm in a 32% bracket. So I'll know to come here and put in 32%. I want to put in that client's email, sampleclient@gmail.com, and I'm good to go. Now, just so you know, this is all optional stuff for you. It's optional CRM type information that you might want to collect on that client if you don't already have information. Maybe it's a new prospect or a phone lead. But right here, we've put just the 4 quick fields that we want you to fill out consistently under client information. So keep this in mind. I can click refinance, give it a sample title, put in just 4 fields, and I'm right down to my current liabilities. And this is where I'm going to add my liability. So I click to add a liability. What kind is it? It's a mortgage because this is a refinance. And you'll notice again, I got a details box. Let's pop that up. And the details box is going to say, tell me about this property. It's a $250,000 property. That's their estimate. It's a primary residence. 30-year fix is what they have. It's with a local bank. The original loan amount they borrowed was $200,000, and the start date on that was around January 30th of 2009. The interest rate at that time was 6%. Their current balance today is $198,560, and the current payment estimate is $1,199.10. Now I might ask the client and say, well, what do you pay each month? They say, well, actually we rounded up to $1,200. That's great. I want to know that because that's what I want to put in here because I want to know what they're paying today. I can put in property taxes, insurance, mortgage insurance. These are really important if you think something's going to change. Maybe they were paying MI today and that may go away. I want to put that in here because that's an expense of that loan. Let's just say we go ahead and put in that they're paying $200 a month in property taxes, and that's tax deductible, and they're paying about $55 a month in homeowners insurance. And their mortgage insurance, they don't have that. They have no homeowners association or other dues. So I click the save button, and now I've got all that information in there, and I'm done with one exception. This is one of the most important boxes on the software. It's called important objectives or statement of interest. I want to ask the client, tell me if we were to work together, what would you like to see? What would you like to accomplish for this to make sense for you? I really want to know why they're thinking about this transaction. It's not because they're bored. People don't go out and spend money and time when they're bored. Just because they're bored. They do it because there's a specific goal. I want to know what that is. So tell me, what are you trying to accomplish, Mr. Client? And he says, well, I want to lower my interest rate. Well, I'll go ahead and put in lower your interest rate. But don't stop there because that is just the surface. Tell me, how much would you like to lower your interest rate, or how much would you like to see your payment drop for this to make sense to you? Get more detail. Well, I don't know. I was thinking, rates around 4, but I really would like to save, $100 and $150 a month. Okay, would like to save $150 per month. Let me ask you a question. If you could save $150 per month, do you have a plan for that? Is this something that you're doing to increase your savings, or would you like to accelerate the mortgage payoff? What's going on? And they might say something like, well, we're trying to save more for college, and we'd like to pay off the mortgage early if possible. Great. Is there anything? And so at this point, you could say, is there anything else that you'd want me to know about this transaction? You say, well, yeah, we'd like to, have this be as easy as possible. Okay, so simplicity is important for you. Great. Is there anything else? Is there anything I should know that you're not interested in? Is there any product or other concerns that you might have? This is a place to get it all out on the table and find out what they're really thinking. If you understand why they're doing the transaction, what they're trying to accomplish, you can get a lot of problems solved at the beginning of the process, because you may find out things that you wouldn't have found out till much later when it's much more difficult to deal with them. The key, though, I found in doing this for over 20 years is that if I'm in alignment with my client, if we're in congruence because they know that I understand what they're trying to accomplish, I and they are going to be effective partners in working together, and I'm going to dramatically increase my conversion rates. And that's what it's all about, increasing your conversion rates. So this is our first section here. We spent a lot of time narrating. In the next lesson, we'll simply go through and very quickly do a plan from start to finish. But I want you to understand some of the psychology here in terms of how this was designed to be fast, simple, and easy for you. We have more advanced, detailed interview questions, but I'll show you that in a future video. For now, all I need to do is click the Borrow tab, and that's going to take me over to my actual analytics. And the software is going to go through and look at that situation, and it's already going to make some recommendations of some possible scenarios that might make sense for your particular client. So we've got a mortgage right now with a local bank. I've got a loan amount of $198,560. I've got a pre-tax rate of 6% and an after-tax rate of 4.080. Now, this is a critically cool thing to understand. People know that interest rates on their mortgages are tax deductible, right? Most people understand that, but they really don't know what that means. Well, what we've done is made it easy for you to tell the story for your client. You're borrowing at 6 right now, but based on your tax bracket, you're really paying about 4%. And the reason being is your payment of $1,455 that you pay each month, you're getting about $382 of that back on your tax return. So that means it feels like 6% because that's what you're really paying, but your real net cost is about 4.080%. This is a neat thing to understand. Also, you've got 353 months to go based on your current balance and the current payment that you're making today. So we know about how long they have to go on that particular debt. This is what we call the scratch board, and it's the place where you can build your options for your client. You can expand or collapse any loan program, and I can take away that 7-year ARM, or I can edit it, or I can come in here and I can say, you know, I want to go through and I want to show this 30-year fixed. It went ahead, it's pretty smart. It said, you know, we're going to need some closing costs here. So it went ahead and took that $198,560, and because your estimated closing costs are $3,000 for most of your clients, it's already tried to build that in for the client. It even knows to split it out into a second if it can to avoid mortgage insurance. So I might say, you know, I don't want to do a second. Let's just do a $200,000 first and keep it at 80%. Notice everything here just calculated, and you'll notice everything below also is going to be changing as you're doing these numbers up above. So here's where I put in the property value. This is where I give a name for each scenario. Let's call this a 30-year fixed. And notice I can use any one of these to create my programs. I can have up to 3 program scenarios side by side that I build. I'm going to override the rate here and say our rate today is a little bit better. It's 3.875. So again, the defaults are coming in to make it fast and easy for you, but you can override them on the fly. And when I look at the payment option here, it also has all of my stuff brought in. I can copy that from one of the other scenarios I've done, and it's going to default to the information that I've already put in here. And I'm going to say all that looks good, so I'm just going to save it like it is. It calculates my APR. Now we're calculating your APR, but if you want to match that exactly, maybe your software or your program comes in at 3.972, then you can use this and override it so that we show the same APR that you want to show in your actual report. So I'm going to leave it at the default here and keep it there. And we now have that ability to go in and say, what else might this client want to see? They said they'd like to pay things off a little bit early, but I want to show them a 15-year fixed as well. So I'm going to go ahead and call this a 15-year fixed. And I just click the duplicate 30-year, and this will bring whatever's up here down for you. So it's a very fast way to get information in. I go through and I want to click the 15-year fixed product at 80%, 200,000, and the only thing I need to adjust is the national average here is 3.375. We're a little higher today. We're at 3.5, so I'm going to put that in here. And notice again how quick that was. I've got now 2 scenarios, and notice below, what you see is what you get. So below you are seeing the 3 loan programs compared side by side. If I take something away, if I decide just to compare the current to the new 30, it's just going to show that for my analysis. If I want to go back and add this 7-year ARM back, and I'm going to go and call this the 7-year ARM, it's a description. This description gives you a lot of flexibility for how you label your scenarios. And I'm going to go ahead and just say, we'll just do the same thing. We'll just keep this at 200,000 first position, and this one's a little bit lower today. I'll put that in. And notice again what's happening below. See, it's all dynamic. You never lose anything. That 15 years is still here. But if I shrink it up, it disappears. It makes it easy for me to just show what I want to show for the client. So now I've got my options in here. Right now, let's just say I want to show the 30 and the 15. And if you've watched any of our other videos or looked at best practices, you probably are aware that the way we approach this is in answering 3 key critical questions for your client. The closing cost impact is the first. People need to know where they stand from a cash perspective. What's my cash impact at closing? So you can just pull in something very simple, like just plug in closing costs. We see a lot of people just use this one number, closing costs, and you'll notice everything's color-coded. Red is bad. That means cash is flowing away from me as a customer. Green is good. That's cash flowing towards me. So this says I'm going to spend $2,500 at the closing table, but I'm going to be getting back $1,440. So my cash that I need to close is $1,060. Okay, I have $3,000 available, so the software is saying you're going to have $1,940 left over. But notice how smart it is. It's saying in your current situation, you have $3,000 that they said they had available. That $300,000 is still left. If you don't refinance or buy the house, that money is still yours. If you do the 30-year fixed, you're going to have about $1,940 left over. If you have the 15-year fixed, you'll have $1,940 left over. This gives you tremendous flexibility. I could be showing just a 30-year fixed, but I could show a 30-year fixed with 1 point, a 30-year fixed with 2 points, a 30-year fixed with 3 points. I could show a 30-year fixed with 10%, a 30-year fixed with 20, and a 30-year fixed with 50% down. So you could have the same product and just change one variable like the loan to value or the interest rate or the closing costs, and you're going to be able to show that impact on cash right here. So when clients know their cash position, and if this was you and you knew that you had $3,000 and you were going to walk away with $1,940 of that, that feels pretty good. The next question is, what's the impact of my cash at closing? So I come down below and I look at the prepayment tax impact. Does this make sense monthly to me as a client? Well, I'm spending $1,455 now, and this shows me where that money's going. I have a 30-year fixed here at $1,195 and a 15-year fixed at $1,685. Well, what does that do for me? On a payment difference basis, this is my baseline. This is green. That's good. It's freeing up $260 a month in cash flow. This is red. It's kind of bad. It's bad from a cash flow standpoint. This is going to cost me an extra $230 per month. So the question really becomes, are you comfortable, given the wealth impact which we're about to discuss, but just from a pure cash flow standpoint, is this possible for you? If the client says, yeah, we could do that if it made sense, then I would leave these three and continue. If at any point the client wants to get off the bus and says, I like the 30, but no way I could do that, I'll stop there and come up and shrink this, assuming I'm doing it live. Or if I'm talking to them on the phone or in person, okay, I'll still do that because I only want to show options that really are possible scenarios for that client today. I might say, would you consider a 7-year ARM? Let's take a look at that. And with one click, I expand this. The closing costs are the same. I could free $384 a month up for you on the 7-year and $260 on the 30. And the client says, wow, that's great. I'd take a look at that, although I'm concerned about having an ARM. Well, don't worry. We're going to address that now. And that takes us down to the future wealth impact. Okay? On the future wealth impact, this is that third thing. And again, like every section, these are a WYSIWYG. What you see is what you get. If I shrink that up, then I can do that and only show the client the closing costs and the monthly payment. I don't have to get into wealth impact. I might want to show them the wealth impact without showing them the monthly payment. That's up to you and how you want to present. But anything you show here will be available and appear on your reports. If you shrink it up and don't show it here, it won't show up on your reports at all. So what you see is what you get. And this is something that's never been done in this type of financial planning or mortgage planning software. And that is, we calculate the real wealth impact of your decision over time. You have two different ways to do that. You can do it, think of this as automatic and think of this as manual. If I click minimum, it's going to just bring down the minimum payments that are required for the debts that I have. And I can see over here, over 7 years, I can look at the wealth impact of each of these decisions. But the best way to do it is using our fixed stat scenario, because what this does is it automatically makes sure that the client is making the same payment each month. So think about that. The client today is spending $1,455 per month. Here, they're going to spend $1,071. That means they get an extra $384 a month to spend. They can do whatever they want to. They can spend that and have fun. They can spend that by putting it into a savings account. They can spend that money by putting it into savings for the future. But if they put $384 a month into savings, they spent $1,455, right? They spent $1,071 on their mortgage and $384 they spent for their future savings. Now that's critical to think about because what we're doing is making it really easy for you to explain some very complicated financial math. Because you're going to be able to show the client that you're spending this today, and in each scenario, I'm recommending that you still spend the same amount. That's the easiest way for me to show you the value of my advice. But what I'm giving you the flexibility of doing is you get to choose where you want the $384 a month to go or where you want the $260 a month to go, because that is cash that's now going to be freed up for you if you do this transaction. So using the automatic allows me to show the same payments side by side, and I simply need to know their time frame. How long do you think you'll be in this house? Maybe they say, gosh, I don't know. That's one of our concerns. We only think we'll be here for another 5 years. It may not make sense to refinance. Well, then we'll just click it to 5 years and see if that's true. Let's just say that your property doesn't go up any in value, so we'll keep that simple. And let's just say the after-tax savings rate that you typically would expect if you were putting money in a mutual fund or something is about 5% a year. All right? So the choice that you really have is you can take this $384 a month, this $260 a month, and you can save it or you can repay it. What would you be more likely to do right now? Do you think you'd like to save this money, or do you think you'd like to repay it towards the mortgage? Because you did say you'd like to pay off early. And the client says, I would like to repay early. So let's click repaying. Now what this is doing below is it's always calculating one critical number, and that's your wealth impact. If this number is green, that means this scenario is better off for this client than what they're doing today. If it's red, it means the client is better off staying in their current scenario. And that's the key question you want to be able to answer for your clients. Am I better off moving forward with you or staying where I am today? If you've got green numbers in any of these columns, you know that these options are better for your client than staying where they are today. And in reality, this client's going to save $30,690 over the next 5 years with your 7-year ARM and $19,669 over the next 30 years with your 30-year fixed. If the client says, well, I'm going to be here for maybe 7 years, we go a little bit further, but that's going to save you 44 or 29. If you think you're going to be here longer than that, say 10 years, I can still go out and simulate this. This is going to pull your caps and your adjustments, and it's going to still look at what's the worst case or whatever you'd like to show on that ARM. So you can still show that you're much better off even after 10 years with the ARM than with a 30-year fixed. And what's really exciting is if you apply this $384 a month in cash flow that you have available, if you repaid it as a payment towards your mortgage, you're going to pay that house off in 211 months. So what am I saying here? For $1,455 a month, same amount each month, would you rather be debt-free in 353 months, 211 months, or 240 months? Well, this is a better deal. And if you thought you were going to be there for 30 years, maybe we want to stay in the 30-year fixed. But right now, I'm going to recommend the 7-year because you think you'll be there for 5 to 7 years, and this is going to save you the most money. All of your math, all of your analytics can be done on this one page. No multiple pages, no tiny little boxes and widgets that you have to go through. Everything can be seen here. That makes it so easy for you to go up and down, make changes. If the client says, you know, I love the 7-year ARM, let's look at that. I can shrink this up and make the other go away. Now we're just comparing the 7-year ARM to what they're doing today. Now once I get this dialed in and the client is ready to move forward, I click the Present tab. Remember, it's 3 steps: Manage, Borrow, and Present. On the Manage tab, we set up the account. It just took a few seconds. On the Borrow tab, we go through and do our analytics. On the Present tab, I build my presentation for the client. I can pick from a predefined plan, like a 2-page plan, a simple cover and summary, a moderate plan, which is going to give a cover and more information, or an advanced plan, where I'm going to go through and give a much more in-depth presentation for that client. I can uncheck all and build my own. I want a cover, I want an introduction, I want to do a 5-page plan, and I want the loan program matrix. And you'll see what these are as you print your plans. Over here I have additional information that I can make available. These are appended materials. Let's say that one of the clients has not a good credit score. I click Credit Scoring and Wealth. We're going to add that information to their report. So it's that easy. We'll talk about some of these other features later on, but I now have the ability to, as a PDF, go in and print a report for the client. I can print it as a web page, or I can do a live desktop share. We'll talk more about these in the future. Right now, we'll focus on the default as a PDF. That's going to create a nice print version for you, and when you click that and open it up, you're going to see the plan that was just created as we went through this process. Right now it's pulling your branding, your information, and it's going to open that up as a PDF for you to take a look at. And there we have it. Here's our nice PDF presentation I can send to the client or I can print. It's going to go through and show all this information. We'll be talking more about these reports in future videos and different ways to utilize them and interpret them. But you're going to find some very, very cool information here that you can present to your clients. So I'll shut that down. For most people, the PDF is a default, although many of our clients are using this on screen live with the client, either desktop sharing or in their office, depending on whether that feature works for you. So this has been a long video, but I want to take you through a full case study here. In our next one, I'm going to take you through one very quickly to show you if I was just sitting here doing this for a client or on a phone presentation, how quickly I can go through and build a refinance plan for the future.